guy called for home insurance, and this was a local, this was close by.
Yep.
And he's like, I need insurance. Okay. He has a pool in the back. I'm not joking. I hope I can get the picture. Maybe I can make it work.
Yes.
A slide from the roof of the house.
Awesome.
Into the backyard.
Where's this guy live?
Like a minute from me.
Cool. We'll bring a sixer and Natty Bose.
Yeah, we'll do a live remote show.
Is it like an open slide or a tube?
An open, like half,
so it's like a slide, like you could slide out.
Yeah, completely.
Oh, man.
You had to exit out of like a dormer window
and like
climb on the roof and then down and then onto the slide. But he called me for insurance and I'm like, I don't think
you're going to have to screw that dormer shut.
Yeah.
Welcome to the podcast dedicated to real estate, insurance, and building your business. Join us as we take you along our own business building journeys with additional wisdom from our network of local and national experts. Welcome to Bricks and Risk. Hey everyone, welcome to another episode of Bricks and Risk. I'm Tim Garrity.
And I'm Sean Mooney.
Today, Sean, we got one of your homeboys on.
Yeah.
We have Sean Kent, Senior Vice President at First Service Corporation. How you doing today, Sean?
Good. Stoked.
Welcome in.
Yeah.
Stoked to be here.
Thanks for coming in. So, background on Sean. Sean is a national expert in community association insurance, serving the insurance needs of more than 8,000 condo, HOA, and co-op communities throughout the U.S. and Canada. He is the SVP for First Service Financial and FS Insurance Brokers, the largest financial insurance services provider for the residential property management industry. His responsibilities include leading FFI's insurance retail brokerage, managing general agency, and insurance distribution operations. As an insurance veteran with 20 years of experience, Sean is also a published author and a regular contributor to national media outlets on topics related to property and casualty insurance. Right up your alley. He's a LaSalle College High School graduate with Mr. Mooney over here.
Better get it right.
College High School. And he went to Hobart College, played lacrosse.
Mm-hmm.
So did your paths cross at LaSalle High School for lacrosse?
Yeah.
He was much younger, but yeah.
He was, you were his mentor?
Yeah.
Yeah. And you're married with two girls.
What were you mentoring?
Yeah, right.
Yeah.
All right,
Let's
cool.
Not get into it.
Brown balls.
So here's a great question. So have you always been in corporate America? And if so, how did you rise to the senior vice president position that you hold today?
All right. That's a good starting question. So no, no, I haven't. So I graduated college in 2003 and moved out to Southern California in San Diego, where I had a college buddy who was in the mortgage business. So if you think back to 2003, 2004, or 5.
I was in back then too.
Good years. Option arms.
Yeah,
It was 4 or 5 points.
Swinging, man.
Woo.
I cut my teeth in mortgages.
Yeah. So it was super fun. I mean, we were 23, 24 years old. And it was very entrepreneurial. It was small. Sterling Funding Corporation was the name of the company.
Okay.
And it was basically me, my buddy, and another guy who were more or less leading the operation, and fun times. But in 2006, we kind of saw the writing on the wall. We went like a couple months without making any money, where like it was gangbusters up until that point.
Right.
So we kind of saw the bottom drop out.
In advance of the
Because I mean that was the epicenter of it, right? It was like there in New York, where like depreciation just was not in anybody's terminology, right? So, so I decided to. I kind of thought I wanted to move back this way, so I had a couple opportunities with either commercial real estate, banking, and insurance, and I took a job with an insurance company called Crum and Forster in 2006 and went through an underwriting training program. It was a great company, great experience. Was living in New York and North Jersey at the time. And then in 2008, I decided I wanted to get into the brokerage side of the business. And I went to work at a local firm called JKJ. You guys probably know a lot of those guys.
Yeah.
Mm-hmm.
Awesome firm. I was there for 7 years. Great experience. Awesome culture. Still, I can't say enough about that firm and all the people. So I've stayed tight with them. But was recruited for the role I'm in now. I got hired as a vice president, so they were looking for somebody to really build out the insurance division, and that was 2014, I guess it was.
Okay.
So, yeah, I came to First Service, and it was a lot of fun. It still is. It was very entrepreneurial at that point, and I was tasked with essentially building the insurance business, mostly on the East Coast and in the Midwest, and certain parts of the Midwest. I had a partner who was responsible for the banking division, and we were kind of a tag team, and we were on trains and planes every week and building relationships, doing deals with brokers, which is a lot of what I do now, is manage relationships with brokers that specialize in condo HOA.
Yep.
And just grew tremendously. So at that time, I think we had maybe 10 employees total across US and Canada. And I think we're 65 associates now.
Yeah, it's grown.
In about 11 years.
So
right?
was it like keys in a blank check that they said, hey, we're looking to grow, come on in and get to work?
Yes.
Good answer.
I mean, listen, it's a great culture, and we can maybe we can get into that part of the conversation a little bit, like in terms of empowering, hiring the right people, right? You get the right people in, like you have to have trust and faith that they're going to do the right job.
Yep.
And at that time, our key associates were those people, right? We didn't have much support backing us up because we were doing it all. And it was like a sense of empowerment that like, we're just going to get things done. Right. And I guess I could probably say like, I'm a ask for forgiveness later kind of person. And my partner who was doing the banking side was also like that.
Does that align in the insurance industry?
I would say so.
Not on the underwriting side, I don't think.
No.
Yeah. But yeah, it's been a fun ride. So I mean, to your question, like, how do I get here now? Listen, I have an unbelievable team, right? So I've been really blessed with having the right people on my team, having a great leadership who has been super supportive. And
yeah, because you don't find that everywhere, is people to believe in you, to say, hey, here you go make this work and grow this. And that's not always the case.
Yeah, I mean, it's a balancing act, right? Like, ironically, I was reading this book that was suggested to me last night called Beyond Entrepreneurship. This is like the second edition of it, but what the chapter I was reading last night was all about leadership and kind of like what's effective leadership, and it has all these case studies from companies like 3M and all these other places, and it's like the Steve Jobs of the world, who were early at Apple, who were like kind of like the genius with 1,000 helpers, is not that effective long term. Maybe short term, but like long term, you need to have trust and put faith in the people who you're putting in key positions. And it talks about like a bus, right? So you have to fill all the seats of the bus with people are high performers and are going to do the job for you, especially when you're gone, right? And I think in many respects, that's kind of how we built First Service Financial, and we've been lucky in that regard.
Nice. All right, let's go back to 2006. I didn't know you were in the mortgage industry.
Mm-hmm.
What was your experience back then with slinging mortgages to?
I mean, it was definitely slinging
to people in a hot market.
Yeah.
In California,
in Southern California.
It kind of reminded me, like, not the mortgage side, but the real estate side. It kind of reminded me of like 21 and 22, where it was just so hot. Like everyone's trying to buy a house, like everyone's tripping over each other. But this time around, the financing was conservative. You know, they weren't doing any of the kind of loans that were around when you and I were in the industry. And what was that experience like?
Yeah. So, again, I was young, right? And we were young, and it was a young industry out there. Particularly, there were a lot of people that were really cutting their teeth in real estate. So it was, when I say it was a good experience, I mean, just in terms of like cutting your teeth, it was a grind in terms of cold calling, right? Like you had to cold call, That's how we got business. And then from there, I mean, you had some relationships and some referral based business, but for the most part, it was cold calling, right? So it was a good experience as a young professional, just like trying to figure things out.
Yeah.
From there, it was you had to sell. Like you had to be a competent salesperson to get the deal across the finish line. So, you had the buyers and refinancers that we were selling to, and then you had your appraisers and everybody, and the banks and everybody else that you had to line up.
Mm-hmm.
And the financing, to your point, was kind of the simple part. Like there really wasn't. Again, like I said, it was all about appreciation.
No
right?
doc loans.
Negative amortization loans. I mean, it is wild to think about that.
People
right?
can't even like fathom. Like, remember no doc loans?
Mm-hmm.
So we're going back a little bit. Basically, is like as long as you had a really high credit score, and I can't remember what the job history requirement was like. You just verbally did an application, which everything was pretty much over the phone back then or in person.
Yep.
And it's yeah, cool. You got a mortgage. Like no bank statements, no tax returns, no pay stubs, no W-2s. And like what a risk for the lenders that were offering that.
Yeah, I mean, listen, the no doc loans, that's one part of it.
Yeah,
the other part are the people who really should not have qualified for those loans,
exactly.
right? So and then it was all about loan to value ratio, and like if you could make sense of it and you could sell that to a bank, then guess what? They're getting qualified, and like they're qualifying for an interest only or negative amortization loan. Yeah. Oh, by the way, as the borrower, like you can choose what you're going to pay, and guess which one they would always pay.
Explain.
Right?
All right. So for our listeners and watchers, because I know what a neg am loan is. Explain what a negative amortization loan was.
Well, you might do a better job, but so it basically you pay less than an interest only monthly payment, which tacks on principal to your loan.
Yeah. So if you had like a payment and it was like $1,000 a month in interest, like you could pay $800.
Yep.
Which meant you were adding $200 in interest to your principal balance.
Yeah.
And some of these loans had very low down payment options. Were there 100% negative amortization option arms? I can't remember. You might have had to have at least 3%.
Yeah.
Or 5%. Yeah. But still, like think about the risk of that.
Well, there just wasn't enough regulation around it. And I think looking back on it, like the writing was on the wall, right? Like because, you could call if you needed a value on a home, you knew who to call.
Yep.
Right. And that's,
get me this number.
This is like, go to Billy. Billy knows how to get that value. He's good with comps.
Yeah.
Like, that was really what happened.
But the whole system was kind of broken too. So when we're talking about, so like most, what's the average? How much does a mortgage broker earn today? A point, maybe?
1 to 2.
Yeah, 1 to 2. Okay.
Yeah, depending.
Well, if you were selling an option arm, you could make 5 points. Right. So think about that. I mean,
I know.
All you had to do was sell like one $300,000 loan in a month, and you're making pretty good money.
You're like, I'm going to Hawaii.
Let alone like 10. Yeah. Like I think I took 1 month off because I had a good month and like bought a bunch of surfboards and it was, it was crazy.
That is crazy.
Yeah.
You had a boat in Southern California that said Option Arm. That was the name of the boat.
Imagine that though. Like you have like a credit card and you go out and you spend $1,000 and the interest on that is, let's just say like $100. And the credit card's like, just pay me like 50.
I'll tack on 50.
Yeah.
Like just the math of it.
Well, per Sean's point, I think where it was back then is that really residential real estate had never really experienced any kind of depreciation, not in a way that was a risk to like mortgage bankers all over the country. Right. So they basically looked at it was like, we kind of can't lose because at the very least, we can still sell the house if they stop paying us. And there'd be a little bit of equity from maybe like their small down payment. And if they added on some interest to their principal, like we'll break even, whatever their thinking was. What they didn't foresee was real estate values going down a lot.
Quickly?
Quickly over a multi-year period from 2008 to 2012. Like there were some markets that lost like 50% of their value. And it really was because of the mortgage financing that was given and the high default rates of people. They're like, I just lost my job. I got this option arm that's adding principal to my balance, and the property's worth $50,000 less than what I paid for. So it was like a perfect storm of like, people were losing their jobs, property values going down. And then again, when you sell real estate, sell residential real estate, like there's a cost to sell.
That's a perfect segue into Sean's experience with insurance in 20.
You were just chomping at the bit to get to insurance.
I just jumped.
I was happy to be talking real estate.
Let's talk about that.
So what is going on right now in insurance? What are you seeing? So you
have different, you're in different segments of the insurance.
Yeah, but it's a whole tidal wave. This whole thing is a tidal wave.
Industry wide.
Yeah. And it could be down in Texas, it could be in Florida, it could be California.
Yeah, give us your perspective on what's going on in insurance.
Yeah, so well, to your point, to your comment, I mean, I'm technically in commercial insurance, right? Because we work with commercial insurance companies that specialize in large condo associations, co-ops, HOAs, right? So it's called habitational in the commercial insurance business, but that's my focus. Because of many of the market trends, there's much more crossover now when it comes to people living in condo and HOAs, and the impact that the commercial insurance or the master policies for their communities have on their homeowners insurance or their out-of-pocket deductible expenses if they get assessed, right? So there is a lot more crossover now, and I think that homeowners insurance companies within the past couple of years, and I saw this particularly in Texas after the big freeze a couple of years ago.
Oh, yeah.
They've gotten a lot smarter, right? Where they acknowledge that
was that when their power system went down? Was it like the ice storm? Is that?
It was I think the power. Yeah, I think the power system went down too. But there were just massive losses due to freezing, right?
And then they had a certain percentage that were solar, and the solar went out because of the freeze. There was a whole multi-dimensional problem down there.
Yeah, but we know what happens when things freeze in places where the buildings aren't built to sustain it, right? It's like major water losses. So I think like that's one event where I realized, and then there's been others too, especially with wind, hail in the Midwest and Texas and other places where homeowners insurance companies were getting whacked, right? Because the deductibles for the commercial policies continued to rise. And when they have a claim, they have to assess that deductible back down to their homeowners, either through a deductible assessment or through their annual budget by increasing their
like
their
if there was
fees.
like a $10,000 deductible. I mean, what's normal in like an HOA, like for one of those things?
Oh, $10,000?
Yeah, I mean, I have no idea.
No, that's like 7 years ago.
Yeah.
Well, it depends on the cause of loss.
You and I were talking about the one. Remember this one we were talking about? It was local.
Yeah. It was around here.
Yeah. And it was a 1% on a $10 million or even more.
Right.
It was like $15 million
like
commercial.
150 grand deductible.
Yeah. So more than that.
No. Oh.
Yeah.
Gotcha.
So for like wind, hail, named storm, we're talking anywhere from, depending on your location, anywhere from 1% to 10% in some places.
Wow.
Of the total insured value.
Yeah.
Right.
And then you were saying that like, so when the HOA, the homeowners association would get whacked with that, they would go back to their condo owners and either special assess maybe, or increase the budget to say everyone's condo fees now have to go up like 10% or 20%.
Yeah.
Because we need to pay for this thing. What would you rather do? Would you rather I ask you for a check now? Or would you rather I just work it into like a monthly billing?
Exactly.
Or both.
Or both. Yeah. So, and here's another, like on that point, here's another crossover between homeowners insurance, lending, and the commercial insurance, right? So you might be selling a condo unit, or you have a purchaser of a condo unit. Let's say it's a large condo building. They have a per unit water damage deductible of $25,000 per unit.
Wow.
Which is pretty commonplace these days. So Fannie Freddie have an insurance requirement that stipulates that the deductible cannot be more than 5% of the total insured values.
Oh.
Okay. So now that comes into play all the time in like places like Minnesota, where there's a large wind hail deductible, say of 5%, that makes sense, right? Like it's just that
they have a problem,
right? But it's just become kind of more prevalent in terms of like water damage deductibles for condos in Philly, for example, where they may have to restructure their deductible structure to get below that 5% just to have somebody qualify either for a refinance or a new purchase for a Fannie Freddie loan.
So that affects the saleability of condos and people being able to buy them too,
and the market values. And if you're somebody living in one of those communities, you're freaking out. If you're a board member, you're looking at your insurance people, you're looking at your lenders and saying, you guys need to figure this out because this could be a big thing. Now, the problem is the appetite for insurance companies right now is such that they're not willing to bend if there's been significant water damage losses or significant wind damage losses, and they just can't justify it. So there are, there's a fair amount of communities out there that are not able to have, owners or prospective buyers qualify for Fannie Freddie because of these issues. It's crazy.
Yeah, it's so I've owned a condo myself. I've technically owned two. I had one in Florida. I had my Sarasota special.
That investment.
And then I had one in Roxborough. And so the one in Roxborough, this one's interesting. I won't name the community, but I think it was the first master planned condo association in the state of Pennsylvania, which was like somewhere around like the mid 70s. So, and Manioc Roxborough is like hills, it's like, this is a hilly area of the city. And this place is built on a hill. Like my condo unit had a 25, 30 foot boardwalk that went to my front door because I was on the second and third floor, but I had a unit underneath me in the topography of the land.
I think you just gave it away.
Anyway, if you're not local. And because it was so old, like you probably see this with like older HOAs. Like what was interesting is that the gas usage and the water usage were both included in the condo fee. So some of the older condos, like buildings downtown, they have this too, where some of your utilities, and those go up every year. Like your utilities are always going to go up over time. So what kept happening is like, oh, we got to raise it 2%. Oh, we got to raise it 3%. We got to raise it 1.5%. You do that over a 40, 50 year period. And I had a 3-bedroom condo there that the time I sold was about 4 years ago. My HOA fee was over $600 a month, and this was a $200,000 condo
in Roxborough.
And I think part of the reason the values were, let's say, stunted compared to like a 3-bedroom row home in Manioc or Roxborough in the neighborhood was because of the condo fee. You buy a home in the center of town. There's no HOA. You don't have that expense, so the value will go up a little bit more. But to your point, if you have a high HOA fee or you have a poorly run HOA or you get storm damage, like whatever it is, those damages have to get put back on the members of the HOA, which are the condo owners. So it's either going to be through your monthly fee, or they'll say, you know what, you owe us $5,000 each and you got 6 months to pay. And that's a downside of owning a condo from like a real estate standpoint, is you have this risk always hanging over your head of like, what's the HOA going to do? How are they going to handle their business? And I have found, because I'm actually my house now in Flowertown is part of an HOA, but it's very, very low key. It's not condo ownership.
Yeah, same for me.
Yeah. So it depends on like how involved your HOA is in your community. Like you can literally, like you said, you can devalue properties if your HOA is poorly run, or God forbid it's weather related or something.
Well, isn't that Florida right now?
Yeah.
Florida. There you go.
But the way
Tons of condos down there.
Yeah.
But specifically right now with the assessments and the inspections of what they're pushing onto the, and it's driving the real estate market down there, meaning people are leaving and the values are just totally out of whack.
Yeah, I think there are a lot of people leaving for kind of what you talked about. We call them halfbacks. They come halfway back and go to South Carolina, North Carolina.
Nice.
But yeah, so you're spot on. I think, and you kind of touched on it, right? Like it needs to be like, the problem is these are business entities, right? The condos, co-ops, HOAs, they need to be run like a business, yet you have volunteer board members,
right,
who are the ones who are responsible for it.
I was an HOA board member.
So congratulations. Yeah, me too.
Thankless jobs.
Yeah. I can go deep on that one if you
That'd be
want.
another
But,
episode.
but
We'll bring you
it's
back.
so important to have a property manager who's going to help you navigate through all of that, right?
Yep.
And like, so First Service Residential is a property management firm that I'm attached to. The biggest and best property management for condo HOAs, right? We're very big in Florida, for example, right? So what you're talking about in terms of those things that over time add up and impact your monthly HOA fees are things like deferred maintenance.
Yep. Deferred maintenance for sure.
Insurance claims, not handling insurance claims properly or not having, the right team involved. Not having access to the right lending products, not managing your money well, right? All of these things, right? So having a professional management company to help you through that is what you pay that management company for as a board member.
Mm-hmm.
So when you have the perfect storm, no pun intended, in a place like Florida, where insurance premiums have skyrocketed. By the way, we're seeing some relief in Florida, shockingly, on the insurance. Yeah, a little bit. So this year will be interesting. But you have insurance premiums going up. You might be in a building where they have deferred maintenance, and that just compounds itself, right? Because you need a new water riser and you didn't save for it, and guess what's going to happen to that water riser, right? It's going to cause an insurance claim. So, and there's whatever it is, facade of a building, you name it, right? All of these things add up. Or in the Midwest, if you haven't saved for a new roof and you're a townhome community with 200 units, those are big roof lines. You're going to have to replace those roofs, right?
Yep.
So, you're spot on. And I think that it's interesting that you said the first master plan community and maybe in Pennsylvania, but the community association business is beginning to age a little bit, right? So condos, HOAs, when they started really to get popular in the 70s and 80s, if you have not been run well and you haven't saved and you haven't reserved enough money to save for those capital projects, on top of everything else related to the insurance and anything else, inflation just in general, I think you could be in a difficult spot. So there are a lot of communities in Florida that are dealing with that right now. California, you name it. I mean, it's pretty consistent across the country, depending on where you are. If you live in one of those tough geographical
And where do you see
places.
it from now? So just to measure it out, can you just kind of give a comparison? Here we are, 2025, and what's hitting your plate or your desk compared to what it was like in 2020? Just to kind of give our listeners a feel for just how dramatic the change has been in the last few years.
Yeah. So 2020 was still super soft market, right?
Yeah.
Obviously COVID hit. And I think to the layperson, like, people just assume COVID had a significant impact on the insurance industry, but it really didn't, right? There was like a little blip and
you could actually argue that it was good for the insurance market, and it was making companies more profitable during that time, I think.
During that time.
Yeah,
I could see that. Yeah. Less litigious, less liability exposure. Yeah.
Less activity, from an auto perspective, like driving was way down. Like, there are certain metrics that you could use to argue that.
Right. But the market, the insurance market remains soft up until really this year.
Yeah.
Right. So we had a lot of good years there. I would say 10.
Yep.
I mean, 10 really good years where if you're buying insurance, any kind of insurance, it's very competitive, right? Yep. I hate to say it to my personal lines insurance agent, but in many respects, it was a commodity, right? And you could go anywhere and you could get competitive coverage at a competitive cost. So, last year was really the reset, right? So I've done a fair amount of interviews just on reinsurance, and I'm not a reinsurance specialist, but I was forced to kind of dive in a little bit. And,
well, you have to know what that is in the equation.
You have to know what the drivers are, right? And you just follow the money like anything else. So last year, reinsurance companies increased their rates on renewals by an average of 40%. So for insurance carriers who are purchasing reinsurance, their policy renewals, their reinsurance treaties, all the above, went up by about 40%, right?
Wow.
So that had a lot to do with what we're seeing in it today. Well, more towards the latter part of 2024. So I think the bad news is insurance carriers got hit with that. And that was a reaction by the reinsurance industry just saying, hey, like there's something happening here, right? Like the weather events are becoming super unpredictable.
Right.
So all of the modeling systems that they use maybe are not as predictable as they thought. And guess what? Like Helene in North Carolina, California wildfires, that wasn't as much of a surprise, but the fact that it happened to such a significant degree in January, that's a pretty big surprise. So I think it was them saying, we can't continue to lose money. We need to figure something out. And that was their way of trying to stabilize the market, which I think is going to bode favorably. So the couple insurance companies that I've talked to who went through their January 1 renewals, depending on, now again, I'm habitational, which is still a very difficult market to insure in. But they indicated that, hey, there were some increases, but they have their next renewals, their big renewals coming up in April and June. And it was okay. I mean, it was modest, so it wasn't that bad. So I have to assume for homeowners insurance companies, and keep in mind, like the deductible structures have just continued to go up over the last couple of years, like significantly. So, so in terms of like stabilizing the losses on on insurance companies' balance sheets, that probably is going to have a significant impact, especially in geographical areas like Florida, Texas, California, where they have these major losses, wind losses particularly. So, yeah, I think it's probably stabilized a little bit, but there's a new norm. Right?
That's what it is.
There's a new norm for sure. You know it better than I do on the
back.
homeowner side. Yeah. It's not going back.
Deductibles, premiums, you kind of hit that shelf where it's like, where it's an adjusted amount that's not going back.
It's like I agree. A lot of people say that about, interest rates right now, mortgage interest rates. And they're like, some people are like, oh, I can't wait until it goes back down to like around 5% or 4.5%. It's like, yeah, I don't think that's going to happen. I think the new norm, at least for the foreseeable future, is probably 6 to 7. Like that's probably where it's going to hang because it was too low or too long.
But that's a norm, like over and history. That's
6 to 7 is fine.
And I think that's the way with property and casualty is deductibles. Deductibles were not in line because the markets were so soft, right? They could get away with these deductibles that really weren't paired to what the risk was, right? And so these carriers are having to have these insureds put a little more skin in the game. Mm-hmm. That is the new norm. That is where they should be. It's a more appropriate sharing of the risk, I would say.
I think we're focusing on property more than anything else.
Yeah.
And you kind of alluded to auto liability, but I think on the casualty side, so for liability policy coverages, that's not getting much better.
Yeah,
it's not depending on what kind of business you are, how many toys you have as a homeowner. It's not going to be your biggest line item on your insurance renewal, but it's, social inflation is the new like buzzword in the insurance industry, right? So what that means is there's a lot more litigation. People are more litigious. There are
nuclear verdicts.
So nuclear verdicts are claims that exceed $10 million, right?
Oh,
Which is why, like, I can talk about the umbrella market for condos and HOAs for forever, just because it's gotten so challenging, right?
Yep.
Particularly in places like New York where we have labor law.
Yeah.
But yeah, I think most of what you'll read on the market trends indicates that because of social inflation, that the casualty, the liability markets are not going to get much better anytime soon.
Mm-mm.
Hey everyone, this is Tim, your favorite Bricks and Risk co-host. But don't tell Sean. I hope you're enjoying this episode, and I'll get right back to it in a moment. Our audience grows through word of mouth, so if you would please take a moment of your time and give us a review on the platform you're on, that would be fantastic. Please also help spread the B&R word by sharing your favorite episode with a friend. We greatly appreciate your time and trust. Now, back to the show. All right, let me shift a little bit. This is a great conversation, by the way. So you're a published author, is that correct?
Yeah, I won't say what I'm published in, but
okay. Tell us a little bit more about writing on that level
Yeah.
where you're actually putting some information out there in any kind of way, and it's like, you know, people can pick it up, they can read it, they can get your opinion. Like, how'd that come to be?
Yeah, I'll just give you an example. So, I mean, you know, a periodical for the HOA community. I can't think of the name right now, but that I wrote a couple of years ago, and it was on special event insurance. Right? It was topical. It was meaningful for the audience, and I think I talked about a food truck vendor and kind of like what the exposure is. Right. If you think about condo,
like if they have an event for the
so you think about
community,
you think about HOA communities, and you want to
President's Day.
You know, you want to encourage the community to come out, right?
Sure,
like you're part of the community, and you have if you're a large scale community, you have a lot of space to work with. So you want to bring food vendors, trucks, food trucks, artists, that kind of stuff, right? Any kind of exactly. Well, so that's what it was. I think I talked about meat. So there was like a beef jerky vendor, and they're selling bad meat. If they didn't have insurance, they wouldn't be covered for the people that got sick, right?
Oh my gosh.
So I think
about that.
And that was probably like 8 paragraphs, right? So, you know, I think I'm a decent writer. Like that kind of stuff comes relatively easily. So I think it's like you try to keep it simple for the reader.
Of course.
You try to find a topic that people can relate to, and you be analogous, right? Like you create an analogy that's gonna resonate with them and make it easy for them to kind of absorb.
That's great.
Oh, you tell a story. We actually had one. We got a call from. It was a special event request from a client of ours, homeowners, where they just shut down the street. And they were like, I think I need a special event policy. And I was like, oh yeah, what do you have going on? And it's just like, oh, this little street fair that, you know, our neighbors get together.
No one can drive through it anymore.
And I said, why do you think you need this policy? And they were like, well, we're renting this bounce house, you know, sort of thing. And I said,
bounce houses.
I said, who signed the rental agreement? And she's like, I did. I said, we'll get you that policy.
Right.
You know, just for a day or whatever.
Yeah. Oh, jeez.
Bounce houses are no bueno.
Yeah. Trampolines on houses, same thing. Swimming pools, like nobody, like one of the first, now they have, you know, we get hit with all of the, we've talked about it before, but the drones. And they do the roofs to see, you know, how old they are.
To build all that data.
But they also do pools, so they'll look for a pool and then, you know, tell you
cracks in the pool.
Well, no, but
green water,
diving boards, like not allowed, like cannot have.
Oh my!
So if we have, there's like 2 insurance companies left who will insure a community that has either a diving board or a water slide. So think of places like Kansas, Missouri, Texas, where they love this fun stuff.
Oh yeah.
We've had so many communities have actually removed their slides or diving boards, dives, slides, water slides.
Yeah.
Because of that, right? It's just like,
they're like,
we can't get insurance, and if we can, it's going to be expensive. And they're like, all right, we're just going to remove
Dill, I'm
going to
give. Maybe we can put it up. Guy called for home insurance, and this was a local. This was close by, and he's like, I need insurance. Okay. He has a pool in the back, and I'm not joking. I hope I can get the picture. Maybe I can make it work.
Yes.
A slide from the roof of the house.
Awesome.
Into the backyard.
Where's this guy live?
Like a minute from me.
Cool. We'll bring a Sixer and Natty Bose.
Yeah, we'll do a live remote show. And and it dumps some it goes down.
Is it like an open slide or a tube?
I think I think it's an open tube, an open like half, you know, that.
So it's like a slide, like you could slide out.
Yeah, completely. From the roof of, you had to exit out of like a dormer window and like climb on the roof and then down and then onto the slide. But he called me for insurance, and I'm like, I don't think
you're gonna have to screw that dormer shut.
Yeah.
So. You just don't see. Remember, I grew up going to Orland Swim Club.
Yeah.
I don't know if you guys ever went there when you were young.
I've never been. Flowertown Country Club.
Never
What's
been.
Up? What's
Never.
up, FCC?
Never
Did
been
you
invited.
And there was a high dive there too, right?
There is, yeah. They have
Yeah.
a deep section with
Pembroke had a
diving board.
high dive.
Yeah, but you don't see it anymore. So like the
Yeah.
one, I remember the one in Orland, it was like, I mean, I was a little kid. It was so high.
Yeah.
I was visiting a friend in Louisville a couple years ago who you know, and we're finishing playing golf and we look over at the pool and there's like the tallest high dive I've ever seen. This is like 2 years ago.
Yeah.
Wow.
And I'm like, dude, who insures this place?
Someone's gonna
Because
die.
that's impossible anymore.
Yeah. I need the name of that carrier.
They're so much fun
Oh
though.
my gosh. All right. So we asked you a couple questions before you came on, Sean. One question is, what do you love most about what you do? And you had said you love having national expertise and leverage. So why do you love being an expert like in your field, in your space?
So part of the reason that I'm in this role and that I left the place I was at was in part because I realized that a lot of the people who've been successful in whatever they do are truly experts in one thing,
Yeah.
right? Like they have one focus and they become the expert and they're the go-to people for whatever that may be. So that's what appealed to me about this role when it kind of came to me. And it's come to fruition. I just think like, listen, it's comforting to know that you know what you're talking about, right? Like I might not be right all the time, but I'm probably going to know more than the other guy.
Yep.
Particularly because I kind of have that national scope, which is nice, right? So I can tell you what's happening in California and I can tell you what's happening in Philadelphia for the most part. So, you know, I think just having that scope is nice to have because it's hard to come by. And in that same vein, you know, what we do, like the size of our company, affords us the ability to have the leverage to get things done, right? Whether it's, you know, we notice a particular coverage in a directors and officers liability policy that we don't like, we can have the right conversations, get to the underwriter and say, hey, can you put this endorsement on here just to kind of carve that back into the policy, right? Things like that. So yeah, I just, it's fun being able to execute on stuff like that, where if you're, you know, if you're not in the same position, it can be really challenging. Right. And, so yeah, we enjoy it.
That's great. Biggest struggle. It's one of the questions. This is the Ryan Garrity special. It's my brother. What a great question that we've been talking about with mostly all of our guests. Your biggest struggle, you put educating clients on the impact of industry trends. Why has that particular thing been a struggle for you?
I think it's because the market has been so challenging for a number of years now.
Like everyone's pissed.
We are the bearer of bad news 9 times out of 10.
Yeah.
Now, that doesn't mean that we don't add value in other ways, but we're in a pretty transactional business, right? Because board members are looking to save money however they want, so they can, you know, profess those savings.
Well, there's
back
so much
to the
more
residents
pressure
and
now
homeowners.
too, right? So that the roof that they didn't put away for is even more expensive than they could have. So
yeah, exactly.
It's just more pressure on looking to the insurance provider to find something less.
Yeah.
So the anger is more.
Yeah.
Right now. I think.
Well, it's also like you receive premium increases for 5 years in a row. Naturally, there begins a certain level of distrust.
Yeah.
Just because like,
it can't be.
It can't be. This can't be the case, right? Now, I'm not saying that all of our clients are like that. We certainly have some great case studies where we've delivered significant value and savings, but
you have that trust, so they're less likely to pounce on you.
Yeah, I hate being dependent upon and having things dictated to me by market trends and by underwriters who are beholden to guidelines that really are hard to explain to clients. Does that make sense?
Yeah, it does.
Yeah. So,
you don't give the your clients and the board members the phone to your underwriter.
they ask for it a lot. But no, I think it's what was I going to say? There's times when, for example, just in terms of timing, right? So like we start a policy renewal process 90 days in advance of the policy expiration date.
Okay.
We might not get that quote 2 days before the policy expiration date. We have to get the quote. potentially get other quotes, analyze them, put them in a comparison, schedule a meeting with the board, and then go through with the board to have them be upset that it's not the reason that number one, it's coming in late, and number two, it might not be the result that they wanted, right? So I think those are the things that like it's just out of our control, right? Which is like I'm always talking to my team about like focus on what we can control, forget about everything else, right? Which is communication, mainly communication, right? When it comes to that kind of stuff. But so when it comes to educating clients, as I mentioned, I mean, and not to their fault. It's just board members are not educated for the most part. They're not insurance experts.
Right.
They're not CFOs of a company usually. Yeah.
I'm a board member.
And they're all well-intentioned, right?
Yeah.
For whatever reason. And it's difficult to, when you have 5 or 6 on every single board, so every single client, you have 5 or 6 people that you're essentially selling to and trying to win over.
And next
it's
year
hard
it might
to get
be
to all
a
of
new
them.
5 or 6.
Great point. Great point.
Like what you just took the time last year to explain, to get them on the same page, to understand the industry, markets and trends and that. Now a new board's in next year. It's like, oh my gosh, I got to do this again. And that might, to make them comfortable with that risk, might have taken 2 or 3 renewals to kind of have them understand what is going on. And then that changes.
Yeah.
And here you are back to square one with a new set of people that you're then trying to build that trust back.
And maybe that new set of people during that, like before that transition took place, there's maybe $1.5 million claim on their policy.
Yeah.
And they're going, well, why do we have a 5% increase? And we're going, well, that's actually really good considering the losses. So it's all those things. And it's just, again, it's so much effort to try to get to as many people as you can and educate them effectively. Right. And that's the challenge. But like I said, I really think that communication and focusing on the process and just executing on whatever your standard operating procedures are is really important. Right.
Absolutely.
All right. So that brings us to your tip for our listeners and watchers. You said, show up every day and be a doer. And it was based on a book by James McGuire, who was the founder of Philadelphia Insurance Companies. That's pretty cool. Why is that a tip? Why does that resonate with you?
Yeah, so I think I tried to put some context around it. It's I'm pretty diligent in like reading all those kinds of books, and this one was presented to me. Actually, it's funny that Joe walking out was talking about the Irish American Business Chamber because that's where I got the book, and I wouldn't think anything of it. But if you know the story of Philadelphia Insurance, Jim McGuire started that company years ago and sold it to Tokyo Marine for multiple billions. And on top of that, like great family. So the message is,
started as a retail broker.
Yes. Yeah. Specialized.
Yeah.
So I recommend reading the book. It's if you're an insurance person, especially from the Philadelphia area, it's a good, easy read with some great lessons.
Yep.
But the general message is like, you have to show up every day in everything you do. And he does a good job of kind of talking about the importance of staying healthy, being fit, being there for your family, and like balancing all the above, right? Yeah. Work, especially if you're an entrepreneur, like doesn't stop, but you have to prioritize all those things. So, if you just think of that in terms of showing up, like that's really important. If you look at all the successful entrepreneurs or CEOs and business leaders, for the most part, a lot of them do it really well. Right. Yeah. So I found that to be a book that really resonated with me, and they're a great family. I've had the privilege of getting to know Chris, Jim's son, a little bit, and they're just great people.
Oh, that's cool. And your quote was great. You create your own reality. So hard to explain, but impossible to deny. Why'd you pick that one?
Yeah, I think, listen, it's the law of attraction, right?
Yep.
So it took me probably, I was thinking about this morning it's mindset, right? So I was probably 30 years old until like it really stuck with me. I think like my Bible is the book Think and Grow Rich, Napoleon Hill.
It's on my shelf. I haven't read it. As Sean knows, I don't read much, but I do own books.
It's a good one. That was like the
this Sean.
That was probably like the the first
like the foundational business
first
book.
foundational business book on mindset and like law of attraction without actually getting into it. But it's just crazy. I think if you're somebody, I'm pretty goal oriented, right? And I think if you stay focused on your goals and you're really mindful of it, like on a daily basis, it works.
Yeah.
Right. So, your reality can be a world that is less optimistic and even pessimistic, and maybe you're somebody that feels like you're always unlucky. That's not how it works, in my opinion, right? You kind of have to set your mindset and make your own luck, and things happen when you do that.
Well, there's another saying. This is luck is when preparation meets opportunity.
Exactly.
So as much as you think people might be lucky, they're probably a little bit more prepared than the average person. So that's awesome, man. All right. So before we shut it down, Sean, appreciate your time today. Thanks for
likewise.
coming in.
It was awesome.
Why don't you tell listeners and watchers where they can learn more about you and everything you got going on?
I'm not a big social media guy. I am on LinkedIn.
We'll have to remedy that.
Yeah, that's okay. This might be the catapult that I needed.
LinkedIn though, we're pretty active on LinkedIn, so we can loop you in on that.
The group's active too.
Yeah, mostly LinkedIn. So that's probably the best spot. And we have an awesome marketing PR team. So hopefully they like what they see in here today.
Awesome.
But that's probably the best way to find us.
Cool.
Yeah.
Awesome.
We appreciate it. So that's all we have for this one, folks. Thank you for tuning in again to another episode of Bricks and Risk. See you soon. Thank you for joining us on another episode of Bricks and Risk. Our goal is that you walk away with 1 or 2 valuable nuggets, and we greatly appreciate you sharing your time with us today. You can find all B&R episodes on Spotify, Apple Music, YouTube, and anywhere else you get your podcast content. Until next time, keep learning and keep growing.